Cash has been plentiful in emerging markets. Between 2009 and 2012, as quantitative easing ramped up, there was a massive expansion in borrowing on global bond markets by emerging market sovereigns, banks, and companies. As a result, emerging market economies are now closely integrated into global debt markets, and thus more affected by actions taken in developed markets, particularly the withdrawal of quantitative easing. One of the most direct impacts of the quantitative easing unwind is that capital is becoming more expensive and difficult to access for emerging market sovereign and corporate entities. As a result of the change in availability and pricing of capital, Moody's estimates that emerging economies could face a cumulative 2013 to 2016 GDP growth loss of roughly 3%, double the impact expected in developed markets. It is worth noting that reduced access to capital is not just a consequence of tighter liquidity, but also related to economic and political factors internal to each country. Many countries are seeing a coincidence of economic slowdown, political instability, and tighter global credit, and finding it challenging to say the least. As a result, tighter credit is being felt to different extents in different countries, the so-called market differentiation, as some emerging markets have been and will continue to be more impacted than others, depending on the degree of external vulnerability and reliance on external financing. The most obvious impact will be a tightening of emerging market sovereign access to capital. Data show that emerging market sovereigns' borrowing costs are on the up and up. The JPM MBIG EM Sovereign Index has seen bond yields increase by 46% from their low point over the past 3 years to the end of February. In looking at individual countries, it is clear that these increases are not entirely related to quantitative tightening, as internal risk dynamics have provoked massive jumps in certain cases. Venezuela, sovereign bond yields have jumped 88%, Ukraine 79%, and Nigeria 71%. Low interest rates and easy availability of US dollars also impacted the commercial space in emerging markets. Hard currency borrowing by emerging market corporates has grown significantly from $164 billion in 2009 to $502 billion by end of 2013. This has been a boon for corporate growth and investment, but with the years of access to cheap and easy capital slowly coming to an end, what does it mean for business in the years ahead? Firstly, the emerging market corporate sector might not be hit as hard as the sovereign space due to the quality and resilience of the emerging market corporate bond market, much of which is investment grade. The May 2013 tapering announcement did lead to a spread spike, with the Credit Suisse Emerging Market IDBS index rising from 326 basis points on May 15, 2013, to a 2013 high of 448 basis points 5 weeks later. However, the yields have since declined, and in fact, the average EM corporate spread has been lower than the average over the last 4 years, loosely considered the quantitative easing period of 406 basis points. The risk is that as borrowing costs rise, emerging market corporates' positions and ratings would suffer. Between 2014 and 2018, approximately $430 billion in hard currency bonds will mature. Now, the situation could be much worse should local currencies continue depreciating. Foreign currency denominated debt now accounts for roughly 40% of the total in emerging markets. Those companies that are generating revenues in local currencies that are worth 20 to 30% less than a year ago may struggle to repay external debt. The bottom line? This cycle's oxymoron looks like a downside story, but there's an opportunity for those with ready cash, like Canadian institutions, to fill the void and right-size the picture. Remember, it's growth that's the initial cause of the liquidity problem. Until next week, I'm Peter Hall.